Hi, welcome to the first quarter economic update for 2025. I'm Chuck Inglefield. This is being recorded on February the 1st. This is before we know about what might happen with the tariffs with Canada, Mexico, and China, but we will review information regarding that. So let's go ahead and jump right in. So as we sail into 2025, where might the economy and markets be headed? We're going to talk about four different topics. We'll talk about what are the drivers of GDP in 2025. Then we'll take a look at the trends on inflation and how that affects the trend on interest rates. We'll talk about the outlook for stocks this year, and then we'll wrap up with a segment called Focusing on What Matters. So let's dive right in. Economic growth in 2025 is going to be driven by two things: consumer spending and what happens with tariffs. Let's first take a look at the GDP growth since 2001, and you can see the average trend line growth has been 2.1%. Last year, we beat that, coming in at 2.8%. In 2023, we beat that as well on the backs of consumer spending. So you can see the bar chart on the right here shows that consumer spending makes up 2/3 of economic growth. So will the consumer hold up this year? Let's take a look at the trend line in consumer spending. It shows what consumer spending has been going back to before the Great Recession. So if you look at this section here that's grayed out in 07, 08, that was the Great Recession. You can see that consumer spending took a step backward. You can see the spike down in 2020 due to the beginning of the pandemic. And then as we recovered from that, consumer spending has really come onto a new trajectory of growth. In fact, people are just spending money at a rate we've not seen. Will they be able to continue to do that? Well, let's take a look at their finances. I want to first focus on the chart on the upper right, and this shows household debt service ratio. So as a percentage of a household's disposable income, how much of that is going to pay their debts? And you can see that that number is actually not even where it was before the pandemic or going back to 1980. So in that sense, the consumer is in a healthy position, healthier than they've been in a long time. Now let's move on to the chart on the lower right. Here we can see delinquencies on payments of mortgages, auto loans, credit cards, student loans. And this is showing that delinquencies are starting to show up in auto loans and credit cards. So we're reaching points where we were before the pandemic. We've not reached the same heights that we saw in 2007, 2008 during the Great Recession, but this trend line bears watching. This might be the canary in the coal mine as far as consumers running out of steam. And again, consumers are 2/3 of economic growth. So if they're not able to remain strong, then we might see a pullback in economic growth and possibly even a recession. Now, there was another factor that's going to impact GDP growth, and that will be tariffs. And there are a lot of unknowns around tariffs, but there is one known, and it is highlighted by this cartoon. Tariffs are not good for the U.S. worker. They're not good for U.S. households. They can be inflationary, and they can very much dampen economic growth and increase unemployment. As I said, I'm recording this on February 1st. This is the morning of the day that the Trump administration is about to activate their tariffs on Canada, Mexico, and China, but specifically Canada and Mexico are projected to have 25% tariffs across the board on all of their exports into the U.S. That will have a cost for U.S. households. In fact, Bloomberg did a good piece on this that suggests that these tariffs could cost U.S. households upwards of $1,000 per year. So there will be some pain felt by U.S. consumers, and the lower earning consumers are going to feel it most. These are also the people that have been punished greatly by the trends of inflation since the pandemic. So we can ill afford to really do these tariffs in any great magnitude or for any duration without impacting these folks and the economy. In fact, here's a projection of what those tariffs would mean for U.S. economic growth as well as Canada and Mexico. You can see all of these lines are trending down, which means none of the countries are going to win with regard to tariffs. In fact, you can see the US GDP growth would drop by 0.2% per year. I've actually seen estimates that have it dropping by 1 full percentage point per year. Canada and Mexico, more than 1% per year contraction in their economic growth. So nobody really wins in this scenario. These tariffs, interestingly enough, are not about economic issues. They're about immigration issues and fentanyl. So it's not about trade fairness. The tariffs with China are more along the lines of an economic issue and trade fairness. So again, this remains to be seen how this will play out, and it's going to create uncertainty in the markets, both stock markets and bond markets. So it bears watching. I will likely do some update videos as we learn more about the tariff situation and how it might impact the economy, and we will send you links as I post those online. The reason why I want to give you updates on this is because tariffs can be inflationary. So let's move on to talk about inflation. I think it's safe to say that the Federal Reserve will not be hanging a banner that says mission accomplished. And that's because inflation is not quite tamed yet. And that has adjusted the expectations around what will happen with interest rates. Let's first take a look at where inflation is and where it's come from. The Federal Reserve's preferred measure of inflation is this PCE index, which is the blue line here. Their target is to get that down to 2%. And they've been making steady progress since they increased interest rates and created a more restrictive monetary policy. However, as you can see in the last few months, inflation has increased a bit. And so the Fed is still going to be looking at keeping interest rates in a more restrictive stance until they're confident that inflation is moving to their 2% target and will stay there. Complicating their job is the unknown around tariffs. Let's take a look at what the market thinks will happen to interest rates in 2025 and beyond. In this chart, you can see the trend of interest rates over time since 1993 and the projections, which are the dots on the right side of this chart, for where we go from here. The green dots are what the market thinks will happen with interest rates. The blue dots are what the Federal Reserve is projecting. And the market thinks that interest rates are going to stay higher for longer than what the Fed has currently indicated. The market is adjusting already for the tariffs that are expected to be put in place this year. As I mentioned, those can be inflationary. If the tariffs aren't as restrictive, the market will adjust for that. But right now, I think that the Federal Reserve is going to be on pause for a while. So at the last week of January, they said, hey, we're going to pause right now and wait and see what happens with inflation. And that's because of the last few months, inflation trending back up. But I don't think the Fed's going to move anytime soon. And it's because of the one number that I have circled on this particular table. And that shows that their expectation for headline PCE, which is again their favorite indicator, is expected to be 2.5% in 2025, then trending down towards their 2% target in 2026. I think caution is the rule of the day with regard to expectations around dropping interest rates. Again, the market thinks that maybe a 0.5 percentage point. The most optimistic folks are thinking 1 full percentage point drop in 2025. Most of the expectations now are for that to happen in the second half of the year. And again, the tariffs just make this more uncertain as we move forward. So something did happen that was fairly significant in the middle of last year, and I'll explain this chart. It has to do with the yield curve. The yield curve essentially is comparing the interest rates on 10-year treasuries with the interest rates on 2-year treasuries. And when 2-year treasuries are paying more interest than the 10-year, we call that an inverted yield curve. And in the past, that has preceded a recession, or said another way, it's been a pretty reliable indicator of a recession on the horizon. So we're going back to the 70s here. And when the blue line goes under zero, that means the yield curve has inverted. Those 2-year treasuries are paying higher interest than the 10-year treasuries. And you can see after the inversion, we had a recession, which is the vertical gray bar here on this chart. You can see that it happened twice in the early 80s. Again in 1990 and 91, again in the early 2000s, and then the Great Recession of 07, 08. All of those were preceded by the yield curve inversion. we had a fairly large yield curve inversion just after the beginning of the pandemic. You can see there was a small recession associated with that pandemic when we essentially shut the economy down. But the yield curve has been inverted for quite some time. And it finally, in the middle of last year, normalized where 10-year treasuries are now paying more interest than 2-year treasuries. And the question is, will we have a recession based on this very reliable indicator or not? What's happened economically in the last few years with regard to interest rates, with regard to money supply, with regard to the stimulus payments, has distorted quite a few economic indicators. So a number of economists have argued that this one won't be as reliable of an indicator of recession, at least this time around. Let me share with you two of my favorite leading indicators. These are called the Purchasing Managers Indexes. There are two. We'll look at the first one, which is for manufacturing activity. And the way to read this is if the blue line is above 50, or the center horizontal line on this graph, that indicates that manufacturers expect their business to expand in the relatively near future. You can see we're under 50 right now. We've been under 50 for quite some time. It's trended up a little bit, but right now it looks like they're not expecting much expansion, although I would argue they're not expecting a lot of contraction. Now, this actually only represents 1/5 of our economy. The services PMI is the larger one for us to look at. That's 4/5 of the economy. And you can see the services PMI in December came in at 54. It has trended in a positive direction. So the services part of our economy is indicating expansion from here. These indicators are leading indicators, and they are not suggesting a recession in the near term. So if that bears out, it looks like 2025 has the opportunity to be another year of growth for the U.S. economy. What's that going to mean for stocks? Everybody's favorite part of the economic update. Let's start with a look at the details around the current bull market and then move on to valuations and forecasts. LPL did a good job putting together this table that talks about how year 3 tends to be a good year for bull markets. We started ours in 2023, and 2023 was a good year. 2024 was a good year. So let me make this table a little bit bigger. This goes back to right before 1950, and we've had 12 bull markets in that period of time, 6 of which were positive in the third year, 2 of which were negative, 4 of which ended in the third year. So they only had 2 years of duration. The average return in the third year for those that were positive is 5.2%. That calculation actually includes the negatives. That's in line with what expectations were back when I did the quarterly economic update in November, really single-digit returns because of where valuations are. Now let's take a look at current valuations. This is a forward PE measure. It illustrates how pricey stocks are relative to the average over the last 30 years. And currently, at the end of the year, the forward PE ratio was 21.5. The average over the last 30 years is 16.9. So definitely elevated. In fact, if you get above the green dotted line on this chart, it shows that you're in a more elevated position that tends not to last, although in the early 2000s, it lasted for about 4 years before the market had a pullback. So it doesn't say a pullback is necessarily imminent. It just shows that, frankly, valuations are priced for things to continue to go well. If we have a recession, usually we see these forward PEs adjust downward because we have a market pullback associated with that. From these levels, I think volatility is going to be a good portion of what we might see this year. In fact, I pulled up this chart of the S&P 500 going back 3 months, and during that period of time, the market grew by 3.9%. But you can see the blue line was far from straight. There was a lot of choppiness. The end of December was very choppy. The first part of January is pretty choppy. And frankly, the entire period was fairly choppy. And that's the volatility I'm talking about. A nice return over that period of time for 3 months, 3.9%. But there was a lot of angst associated with it. I think this is the type of volatility we might expect in 2025, given where valuations are. At the end of the day, stocks are driven by earnings growth. So if corporations continue to have earnings growth like they've had over the last couple of years due to strong consumer spending, that will support or provide a nice foundation for stocks. So this very busy chart shows us that. And what I want to do is zoom in on the next couple of years projections for corporate earnings. And you'll see here that they are positive. So in 2025 and 2026, 14 and 13% projected growth in earnings, respectively, over those next couple of years. If that plays itself out, that could be a nice foundation for stocks. All of this dependent on not going into a recession. And again, the tariffs being the wild card of how they might affect economic growth and possibly send us into a recession. Let's move on to forecasts for the stock market for 2025. Before we do so, I want to share with you the forecasts that were made last year, and we'll take a look at how those turned out. So I just put together a collection of a handful of financial firms and what their projections were for 2024. And you can see that most of them were in the middle to upper single digits, LPL included. They were at 8 to 10% for last year. The S&P 500 rounded was up about 25% last year. This is a good example of why I never make forecasts, because they're very difficult and frankly don't provide a tremendous amount of value because of their accuracy. In fact, I think these folks have as good a chance of getting it right as anybody else. There's only one problem. I can't get it to predict correctly more than 50% of the time. That said, full disclaimer on the value of forecasts. I know you want to see the 2025 forecasts anyway, so here they are. And again, a handful of firms. These are pretty optimistic. So 9, 10%, a 15%, a 16%. LPL is actually coming in at about a 5 to 7% range, which is more in line with the slide I showed you earlier about third year of bear markets averaging a little over 5%. I think the rule of this year will be there will be continued volatility due to the tariffs and the unknown from the standpoint of their impact on economic growth, which will impact interest rate policy and how restrictive or not it might be, which also impacts the value of earnings and whether we have a tailwind or a headwind for stocks in 2025. I will likely be doing some shorter economic updates in between these quarterly updates as we learn more about tariffs and how they might impact the economy. Let me wrap up with a segment I've added over the last year called Focusing on What Matters. Every once in a while, I'll see on a social media feed, Instagram's actually my only social media. It used to be for photographers, which I'm a hobbyist, but really it's not that anymore, but I'm still on it. Something showed up on my feed recently that I think does a good job of putting into perspective all the stress and anxiety we might have with regard to the world today and the value of our time. Every single thing you do today is something that your 90-year-old self will wish they could go back and do. The good old days are happening right now. And with that, the next economic update will be happening around the first week of May. And of course, you'll get a notification about that. Thank you for your time and attention. I hope you have a great quarter.